Welcome to Stock Odds, Odds and End podcast. This is the weekend edition, I guess. Today's Saturday, December 3rd. I'm your host, Dave Singh, with Rob Friesen here. Good evening, Rob. How's everything?
Good. Yeah, Dave and I made an election to switch it from Sunday nights to Saturday. Possibly we could even consider Friday as well, depending on schedules. One thing we liked about the Sunday night was the futures were open as of 6 p.m. Eastern, and so you can kind of get a little bit of an attitude. But we recognize as well that things can change in that overnight session before they open. So there's no guarantee that what we're seeing at night is going to be there the next day. The whole thing about stock odds dealing with seasonality and the data that's in it, it's supposed to help us plan for the next time frame. And so that's in place anyway. Based on seasonality data we have way in advance. But with the database getting updated from Friday's close, in order to curate some symbols, we do need to consider a few hours after the close before the first set of data is ready. Corporate adjustments are done later at about 8:30 Pacific, 11:30 Eastern time. So it's probably best overall we can wait till Saturdays, but we'll see how it goes. This will enable you guys to get the podcast earlier and maybe helps you with your preparedness for next week as well. So that's the goal. And of course, life, always has its plans for us versus our goals, but nonetheless, here we are. So Dave, what have you been seeing in your research for seasonality and economic reports coming up and so on? We want to start first here?
Yeah, I think first we'll just cover the week ahead here in terms of economic reports. It's kind of a lighter week. There's no major reports or Fed speak like we had the past week. Monday we can expect ISM services, so a little bit of insight into how the economy is doing in terms of small business. On Wednesday, productivity. Thursday, initial jobless claims, that could be interesting, and then Friday, producer prices. So some insight into inflation and jobless numbers, employment numbers. If they still show strength, it means the Fed could remain hawkish. If the employment numbers soften a bit, then the Fed could be a little bit more dovish. So that's what we're looking for in terms of economic reports. And in terms of earnings, there's still a smattering of earnings trickling out here. On Monday, there's 155 companies still reporting, and then throughout the week, about 50 or 60 per each day. So make sure you check your symbols, cross-check them for if they have earnings before or after hours. And then in terms of the entire month, December is expected to be a little bit softer, minus 0.27% for the entire month for the S&P 500, with the small caps being slightly positive, 0.17. So that with that backdrop, throughout different times of the month, we can expect different things. So mid-month, we can expect the spider to be down a bit, about 0.5%, and even the third Friday of the month, options expiration, the S&P is expected to be down. And the only period throughout the month that looks strong is the last 5 days of the month, 0.47% return on the final 5 days, with most of that front-loaded on the first 1, 2, and 3 days of that 5-day period. So we've just come off some news macro catalysts the past week. This week looks a little bit more boring, business as usual, and we don't have any in terms of seasonality of mid-month or beginning of month, but come the following week, we could expect a little bit more softness there. Also, if we look at where we've come the entire year to date, the Dow is really not down very, very much, 25%, but the NASDAQ is still down over 26%. So that just shows a defensive nature and posturing, and even what we've seen with the Dow in the past few weeks, it's outperformed, right? So there's still this risk off kind of posturing happening in the background. And if you look at the index, the groups that are doing the best this year and the worst, again, energy up 44% for the full year, with utilities and consumer defensive falling behind. Those are just slightly down 1 or 2% for the year. And the worst have been communication services and consumer cyclicals. So there's a big divergence between what has done well this year and what has not. I think we need to keep eyes on key levels in the S&P 500. So, Rob, you want to go over those levels that you see on the spider?
Yeah. First, I just want to reinforce here. So the performance for this past week from the diamonds was 0.36, SPY was 1.14, IWM was 1.33, and Qs was 1.96. And so, like, if you look at the more recent data here and then compare it also to last month, you know, the Qs have been sort of picking up some steam relative to the diamonds. So, you know, there is a lot of cash on the sidelines. Fund managers and investors have been looking for opportunity to deploy that, you know, justification. And now I think there's a little bit more stabilization with the bonds, interest rates, and so on. And that we were on a massive trend down with the TLT, for example, and you know that reversed in the last couple of weeks here. And so that gives a more opportunity for people to use both the equities and the bond market, more respective, hedging, more balanced. It's just coming into where there can be the argument to deploy capital. And really that started back on October the 13th was sort of a big catalyst to, hey, you know, we gapped down massively and we just retraced the whole thing plus. And so since then, it's been like they've been consistently looking for opportunity to deploy capital. And Friday, we saw that with our gap down again. And it's remarkable all through, you know, the last while. I mean, it's just Fed banter or, you know, significant players that have a wide following talking about something, whether it's recession or whether it's, you know, more dovishness coming from the Fed in the future. But they seem to move markets a lot and gives us a lot of these gaps. So economic reports, yes. Fed speak, yes. I mean, all this stuff is playing into the market every day. And then on Friday, you know, our unemployment numbers and hourly wages was what, you know, knocked the market down. And, you know, it retraced, it rallied back. And again, that's only because people are, again, committed to finding things on sale, you know, and in inflationary times, you guys know that you like a sale out there in the supermarket or in the, you know, mall or whatever. Investors are no different. We like things on sale. So Friday was a great starting point. And for trading, this is what helps us do really well and make money in a manner that's, you know, sort of not evenly distributed. We don't get that luxury of our returns being completely evenly distributed. You know, we like to track things on a weekly basis and say, you know, how did we do this week? How did we do the last week? You know, are we consistent week over week? Because it's not, you know, easy to be green every single day. You can do the right thing and still have, you know, results that are not what you'd like. One of the things that is a backdrop to everything is, of course, the US dollar. And I've talked on this show many times about when the US dollar declines and why was it stronger? It was stronger because of the anticipation of the Fed hiking rates. And so if you go back to March when we started, that's when it kind of lifted off of its December to February channel and started to rally. And it consistently moved as the Fed was very aggressive. And it was a very, you know, steep, sharp rise in interest rates. Historically, one of the quickest raises that we've ever had, not the most, but the quickest. And so as we roared into September, you know, we were starting to get a little bit more indication that, you know, maybe in the future they would slow that pace down. So that's really why the dollar started to pull back. And then it's continued that. So the move that we've had has been substantial. And, you know, this past week here, we had 3 down days in the dollar. And what does that do? it gives the opportunity for the market, which is priced in dollars, to maybe have a move upward. It also, more importantly, affects the commodities that trade in U.S. dollars, that are priced in U.S. dollars, and so on. So we can look at our commodity base and we can see how well that's done. So moving on to, first we've got the oil. Crude oil has had a bit of a damper on it. We were expecting it to be a little bit more bullish with that dollar pullback as well. But the problem has been the caps discussed on Russian oil, and the lockdowns in China and the recession side of the talk have all kind of hampered the crude oil prices. But again, we're not out of the woods with all that. And, there's a lot more that can develop on the global front, including increase in wars and stuff like that, which could affect it. We'll have to see how this price cap thing actually plays out. And, what OPEC does is going to be a big part of it too. And then our strategic oil reserve has been utilized a lot to lower prices for West Texas. And, there comes a time when you've got to replenish that, or if something else comes along where you're really tapped out. So it's kind of an interesting prospects for oil, but, we haven't gone through the entire winter yet, and we haven't gone into next year to see how things play out. But still expecting there to be more demand, especially if China comes back online in a much bigger way. But the big story is, take a look at silver. And silver is interesting because it has broken out here. So it took out the June high, which was quite corresponding. Well, we had a November high, which didn't quite get to the June high, but now in the last 2 days, we've taken out the June high. And that means that there's a pretty good air pocket heading back up to, say, the March highs, which was just after the war started and silver was kind of spiking in. So we're now back on target with clear blue skies above us on silver. And so if the dollar continues to pull back, I think that can influence that. Gold hasn't taken out the August high that it had. It's approaching it, and it had a pretty good day on Thursday, and then Friday it pulled back and then still managed to hold up okay. So again, related to the dollar, that could move above the August highs. If that does, then we've got some consolidation between 1850 and the highs, so some matching highs there around 1880. Above 1880, it's not like there's not points to test, but a lot more clear blue sky above 1880 for a while anyway. So that's gold. Copper's an interesting one because it hasn't taken out its November high, and it's really tied to, the green revolution. It's really tied to recession or not for 2023. So keeping a real close eye on copper. It's always been sort of an advance indicator of markets getting healthier. So it needs to address the November high and take that out, and then we've got some blue sky there. Okay. Let's go to so now there's a difference in looking at your futures charts on the Dow, the S&P, NASDAQ, and Russell versus looking at the ETFs that track the indices. So with, let's just put in diamonds here, for example. Diamonds had a pretty good pretty good day in terms of opening down below the day before low. So it actually not just below the close on the gap, but actually below the previous day's low. And it did rally all the way through those numbers to close, pretty close to the close of the day before. The fact is we are above the August highs with that one. Now let's put in the SPY here. So the SPY also opened down below the low from the day before, December 1st, and rallied through that, through the low, and then up to pretty much closed the gap. It took all day to do it. It was right just after 3 p.m. Eastern time that it finally closed the gap. And then it closed down from the day before at 0.12%, so slightly down from the previous day's close. The Qs, they've been, the market that's been laggy but starting to catch up. And of course, the big catalyst day was November 30th, where the Qs just ripped and took out, our 3-day high, 5-day high, and even went to match the 10-day high, and that was 293.26, and then we punched through by about 21 cents. So that took out November's high and closed there. So really remarkable day. On December 1st, it was a tighter range day, kind of trying to figure out what to do with itself, and it pretty much closed unchanged. And then we didn't have, for the Qs, as large of a gap down as we did with the Dow, but it recovered and again took all day to almost fill the gap. It didn't quite, and we closed down 0.40 on the Qs. And the better of the four was IWM, which again, if you listen to Dave on the prospects for the Russell for December, it is slightly positive, where the S&P is slightly negative. But the Russell gapped down, significantly, way below the low of the previous day. And it rallied not only to challenge that low and get through it, but it did it in the first, 45 minutes and filled the gap. So quite a different story than the other markets. And then it proceeded to go through that and build on the day and actually close up 0.58%. So the Russell was the remarkable candidate for Friday. And our top 20 Russell list, just naked stocks by itself, produced 3.51% performance, with the IWM only coming in at plus 2%. So, 1.5% more for the Russell, the list of stocks, the 20 stocks that we had, right? And now, even if you hedged it, you were up on a dollar for dollar basis, you were up 0.76%. So that was completely hedged. That worked too. Now, remember, we've talked about how well the Russell can do on these gap downs. And of course, you have to have your hedges standing by. But what I'm getting from a lot of traders and discussing is there's this element of fear. And it's like, you kind of get caught up in what is happening instead of the probabilities of what will happen. And so you have to force yourself to override your emotions and, even the scary thoughts that you have, and say, I'm going to take this trade. And why I can take it is because I'm prepared. I'm loaded up with the ability to instantly hedge off if I see any sign of trouble. And if you practice that, you'll get better at holding through some of the shaking that's really not consequential. It's just emotional, right? It gets to your emotions. But if you're prepared, you'll get better and better at saying, I can hold. Okay, now I need to hedge off. You're just going to get better at that. It takes practice. But you first have to address the fear element, because fear has been something that has held traders back from their best performance and their best types of days, because they're afraid. And we found, over the years, that really it's those things that you're scared to do that pay off the best. But I'm not talking about complacency to risk. I'm talking about, you have your probability list. They was already curated with some research of whatever form you want. If you want to put in more than just statistics and you want to do macro and you want to do other things, that's fundamentals as well. That's great. But you have your list. You're ready to trade the list anyway. And you would, if the market was opening flat, you would just do your list along with your hedges, right? You do your long and shorts. But if the market's opening down, you could change that equation to focus on the long side with your hedges standing by. And there is the risk of some slippage there if we open down and we continue to drop. But if you study this and you do back testing on gap fills, even just simple one, go back and look at how many times the market opened down 1% or more and what happened subsequently. And you'll see, because it's a buy-side market historically, that the gaps largely get filled. So I want to encourage you not to succumb to the fear, but to choose instead preparedness, so that you can improve your ability to hold, even naked, if it's if the opportunity's there. And so only if and when the opportunity's there. But historically, the small caps, they really like some of these discounts. And because they have higher betas, they slingshot back pretty well. So that was a nice showing for our Russell list. NASDAQ list also did well, and that was 5 longs and 5 shorts. And the S&P 500 list also did well, but not the as robust of performance as the NASDAQ or the Russell. It's more mean reverting. It's more efficient and things like that. So there's a bit of a trade-off between that sort of safety element and the production, the potential performance that you get. Okay, Dave, why don't you go through anything else on the news side, or talk a little bit more about what you see on the treasuries, the 10-year treasury?
Yeah, 10-year. It just seems like we're quite a ways down from that high we had in October. So we rallied pretty hard throughout the year. We got to about 4.25% in October, but now we're at 3.5%. So we've really come back down quite a bit on that, and that also supportive for growth stocks. So we have that wind at our back, there's the OPEC stuff. So there's this tension between Biden trying to release oil and then OPEC trying to control prices. So we do have this push and pull in terms of that. But I was trying to study the streaks a little bit more, and there's a lot of interesting reports in the dashboards. And I pulled up one which is a streaks report, and I thought that's some content for you to review as well.
Okay, well, with the streaks, they're from the dashboards, they're projected at 3-day return. If you go to the web screener or use the API, you can, do a 3-day, or you can boil it down to open to close. But just from the dashboard itself, the streaks is a 3-day projected return. So this would be from the close of Friday going out 3 days in what's probably expected to be not much of an eventful week overall. According to the economic reports and stuff that you mentioned. But we can look at a couple of them here. So on the trending upside, we have BNTX and Myrna. Those can be traded as a pair. Same thing with, Pfizer in the mix is a 3-way as well. So there's lots of opportunity for combo trading there. Then you have, is that Unity? Or
yeah, Unity.
No, LI. LI, okay. LI. And then we have Myrna, Futi, and Phase. So looking at the, so what the trending up is that they're streaking, but they may maybe a 1-day up, and they've sort of come off the bottom, and there might be been a channel there or something is showing that it's trending up. The odds on that are not super fantastic for the ones that are one streak, but for Myrna, it has 3 streaks. Odds are 60.9 of a 1.72% performance over the next 3 days. And BNTX is 5 days of streaking already with probabilities of 78.6. So that's in the trending up area. You might want to look at that. Looking at BNTX chart, it has low volatility, certainly a little bit less than Myrna. And Myrna kind of went up too fast and pulled back and then popped up, whereas BNTX is just sort of methodically climbing. So that's interesting there. I'll go to so the trending down category, AAL, Expedia, so a little bit of the discretionary travel stuff, MRO, PSX, both in the energy space, and Snow in the technology space. Of those charts, probably Snow looks the most interesting. It really rallied a lot on November 30th and again on December 1st. It was really quite sideways and uneventful on Friday, whereas a lot of other things were up a lot. So that's interesting to me for a possible move down. I got that right there, Dave?
Yeah, it was really sharp compared to the other charts.
Yeah. On the reversal one, so we're looking at bullish reversals. You've got car, so rental, discretionary, and I might be in the industrial category. I can't remember. I think it is MDB, AMD, NVIDIA. So you've got 2 chips in there. Let's take a look at those. Odds are 54 to 61 all across the board on those bullish reversals. And again, this is 3 days out. Let's look at that. So, yeah, the one that's wait a minute. How come Snow's in there? I'm on the wrong screen then, am I? Oh yeah, I'm on the wrong screen here. NVIDIA and AMD, yeah. Okay. So the ABMD, that one is extremely choppy, right? So that's high noise. AMD and NVIDIA both had big moves on November 30th. December 1st, a little bit more follow through from NVIDIA than AMD. So in terms of the discount, AMD pulled back more on December the 2nd and bounced a bit less. NVIDIA pulled back less and bounced a bit more. So for a strength situation, it's looking like NVIDIA is a little bit more interesting, perhaps. Yeah, I mean, you're going to have to, it's really kind of tough to comment on what's going to happen next from a chart perspective. I think the key here is to look for potential, like what's most discounted, what pulled back, what might have a greater credibility as far as a signal if you want to combine technicals with the statistics. And we'll pull up the bullish reversals. Sorry, bearish reversals. What is this one?
Yeah, next is bearish reversals. There's a
Lennar?
Firm, Unity, MSTR, Lennar, yeah.
So those are bearish reversals. Okay, Lennar. Yeah, those have all been up, and then those are great. I mean, I love when you have some strong numbers in terms of streaks, that you're getting into more price discovery. There's probably a little bit more of a news component, but looking at those for potential reversals, still respecting the strength that might be there, but looking for potential reversals. And MSTR, for example, great performance on Friday, up 4%. Those can pay off well if next week it decides it wants to pull back. Both Lennar, SE, and Unity weren't up that much on Friday, so they don't have that same, powder keg potential of pulling back. So, there is a blend here of performance that's streaked and potential payoff if it's reverting back. But you're going to have to qualify them yourself in terms of what you like. Let's see what else we got. Well, I think it's been a long session here today. I think we can be done on that, unless you got anything else to add. I'll just pull up the map of the market here. Looks like a bit of difference going on between Meta strength versus Google. Meta was up on Friday, Google was down. So that might be something changing there. Drug manufacturers were all up overall. Industrials were up overall. So it actually ended up being a very defensive outcome in terms of the top performances, but the payoff, a lot of it came from the small caps and the tech stocks, even though the tech stocks on a close-to-close basis showing that they're down still, they opened down a lot of them even more and bounced significantly. So they're, you can't always get the complete picture just by looking at the map of the market. You have to look at how things opened and what they did for the day. And some of them opened and very, very quickly had good payoff, even by 10 o'clock Eastern time, that first half hour. So keep that in mind. Aerospace, has been softer for a while. It kind of came roaring back on Friday, the defense contractors and stuff. Basic materials are definitely hot. And that's, again, based on the US dollar pulling back. Financials, a bit mixed right now because they were benefiting a lot from the rise in interest rates. So now if that's not going to be as aggressive, maybe they're just stabilizing. I don't see them being down huge at this point, but with this interest rate pace being subsided, the financials should, not be as strong, not as, aggressively invested in as they were during the phase of interest rate hike. So anyway, keep that in your back of your mind. We finished that week on a bit of a defensive note, and that may persist still for next week. As we're kind of like wait and see what the following week is. We have more to talk about on that news front because we've got, CPI numbers, we've got interest rate decision, and we've got expiration. So there's a lot going on the following week. So this is kind of your quieter week to hopefully, be more of a noise trader, just trading your longs and shorts without, having to worry about too much economic reports. Okay. Hope that helps, guys. Have a good preparation for Monday and for next week. Okay.
Good luck. Thanks.